I'm looking at a lot as like the post-dot-com recession, right? That was one where it was a
Okay.
major impact for markets and a smaller impact for the economy. But obviously, it's going to depend on how policymakers handle that. One thing I think is that a lot of people they fight the last war, right? So they look back, for example, at the 2008 recession, and now they start to fear that every recession is going to be like one of those.
What is it, do you feel, that are the contributing factors to what we're seeing right now in Bitcoin's price movement?
So Bitcoin is historically highly correlated with various liquidity indicators, right? So basically, how much capital is kind of available, liquid for investment. A lot of other investments they trade off things like earnings, they trade off all sorts of other things, whereas Bitcoin is actually one of the purest liquidity correlations that are out there. And ever since autumn of last year, liquidity improved conditions have actually been, in many cases, moving up or sideways a little bit. Basically, they declined all throughout 2022. When we got to the end of the year, the dollar index came off of its highs. You started to get Chinese reopening. You started to get, the market pricing in slower forward Fed hiking. Inflation was off of its highs. You had a drawdown in the Treasury General account. It's kind of jargon for some, but basically, there's a bunch of things that improve liquidity. And I actually think that Bitcoin probably would have bounced in quarter four if not for the whole FTX implosion, because you started to see a bounce in a number of risk assets. We saw good movements in precious metals, including ones like silver, that are historically more cyclical. And so I think that basically this is kind of a pent up move from those overall better liquidity conditions. I think the somewhat concerning thing is that you're also seeing a bounce in like meme stocks and unprofitable stocks this year. And so, I wouldn't be surprised to see some of this be given back or some of this, consolidate for a period of time. But essentially, I think that, liquidity, at least locally, reached its worst point last year, and at least is kind of a mild, improvement. Most market conditions, this would probably be like a top in the dollar, and we'd see more easing conditions from here. Like historically, for example, when you see the 2-year Treasury roll below the Fed funds rate, usually the Fed is done hiking. And so, these in normal market environments, these would probably start to signal a top. Now, because inflation is still historically high, because Jerome Powell has tied his reputation to getting inflation back down,
Right.
they could be a little bit stickier than they have been in prior cycles. So it's possible that we'll retest this. It's possible that we'll experience more turbulence. But I think this is at least the beginning of a rotation in liquidity, even if it's maybe not the final move. I think with the data we have at hand now, that's most likely. We recently saw, for example, industrial production came out pretty weak. We saw retail sales come out pretty weak. There's kind of broad-based deceleration. The New York Fed recession model is flashing recession. And so I think 25 basis points is probably the most likely scenario. Data between now and then could tweak those odds somewhat. Essentially, what we're seeing is that even though they're intending to continue tightening, they're intending to hold their tightness for longer. We are clearly seeing a deceleration of expectations around how much they're going to tighten, in large part because we've seen a deceleration in inflation and a deceleration in economic activity. So I think 25 basis points is most likely.
Also, maybe getting to a point where we may see a pause. Do you think jobs are going to be a critical component for their decision making?
I think around the margins, yes, because for example, if you look at the Fed's mandates, they're not mandated to maximize industrial production, but they are mandated to maximize long-term employment, right? And so they look at basically employment and inflation as their two primary things to optimize for. By extension, they also have to optimize for financial stability. So for example, if the treasury market goes illiquid, if the junk bond market, if that goes completely liquid and stops trading, they pretty much have to step in because that's going to start eventually cascading into failures of financial institutions and employment. But really, at the when it comes down to it, those two initial mandates are what they optimize for. And so the challenge, of course, is that employment is a lagging indicator, right? So usually you don't get substantial increases in unemployment until you're already in a recession. It's basically coincident or lagging compared to other things. Now, we can isolate certain aspects of employment that are a little bit more leading. So, for example, if you look at temporary help, if you imagine running a business and you're facing challenges, you're more likely to let go of temporary help services before you'd let go your your permanent employees that have more experience at your company, and generally, so you see a lot more volatility and a lot of kind of a leading indicator from temporary help, both on the upside and the downside, and that's already negative year over year. The total
Right.
people that are officially employed in that type of work, and so even in the labor market, which is pretty strong, we still see early cracks. Same thing for overtime hours. That's like another leading indicator. It's looking pretty soft. And so, but as long as they're looking at broad-based employment, I do think that they can use that to justify staying tight for a little bit longer than you otherwise would if you're looking at leading indicators. I would expect future waves of inflation this decade. If you look at past inflationary periods like the 1970s or the 1940s, they often came in waves, and that's because policymakers and central banks don't just sit there and let it happen. Central banks try to push back on it. They try to tighten conditions, or sometimes you have policymakers doing things like price and wage controls. That was a historical move that would happen, and so between different types of levers that different types of policymakers can pull, they usually get a handle on inflation for brief periods of time before it runs away from them again. And so right now, as they try to curtail demand, as they basically suppress marginal demand, that helps bring inflation down. We also don't see, money supply was growing very quickly in 2020 and 2021. Basically, it was the fastest pace of broad money supply growth since World War II. But over the past 12 months, you're flat to negative in terms of broad money supply.
Right.
And so I would expect to see continued disinflationary pressures until there's a policy shift, in response to recession, in response to economic softness. And then probably from there, we would have another wave of inflation, because some of the underlying shortages in energy supply, for example, are unresolved, even though they can be temporarily suppressed.
Is there any one area that you feel is a little bit more dangerous for what we might see here, at least in the U.S. markets?
Well, so Europe, obviously, the big warning sign there is the energy shortages, right? That shows how problematic things can be if you don't have your energy managed properly. And the challenge with natural gas is it's a far more local market than oil and coal and other types of commodities, because it's very costly to transport relative to its value, right? You need very specialized equipment. There's only so much, there's finite capacity for shipping natural gas. And so they've run into the shortages. And I don't think, right now they're off those highs. But I think that until they actually have a more structural investment, those could be recurring issues that you see next winter and maybe the winter after that. On Japan's side, it's a very different situation. Obviously, they have similar shortages, but not as extreme. And instead, they're more like they're the highest debt nation of the world. And so what they're doing is actually rippling out, because, for example, Japan, even though they're very high debt, they're also positive net international investment position, which means that they own more foreign assets than foreigners own of Japanese assets. That's from decades of running positive current account surpluses, which they then reinvest in the rest of the world. And so one problem is that when they do start to tighten a little bit, like we saw with the recent move from 25 basis points to 50 basis points on their 10-year, some of that capital goes back to Japan. In addition, official policymakers can sell some of their official reserves, which they have well over $1 trillion worth, to prop up their currency, even if they have an artificially low interest rate. And so that withdrawal of foreign capital back into Japan can ripple through the world, because they're the largest country by net international investment position. So I think both of those are both warning signs and instructive, and they also then have rippling effects throughout the rest of the world. Germany is a major manufacturer, Japan is a major financier, and these are all interconnected. So in equity markets, a lot of the margin debt has been rolled over, right? So basically, there was, during the big spike into 2021, there's quite a lot of margin debt. A lot of that has been reduced, and obviously, we've seen a lot of debt implosions throughout the whole crypto ecosystem. That was basically debt built on debt in this big intertwined connection. So I think that's actually pretty healthy. I think there's still some pockets of debt. Obviously, we have to see what's going to happen with Digital Currency Group and that full situation there. So it's not like debt has been totally wiped out, and it's never, in recessions, you don't wipe out all debt from any industry. You just kind of wipe out the excessive debt around the margins. And so I do think that it is a much better debt situation than it was before, at least in that market sense, right? So there's still tremendous amounts of debt. For example, sovereign debt, corporate debt, household debt, But in a market sense, basically debt tied to trading assets, that's been significantly reduced.
Providing that we still potentially will see that recession hit, do you feel like that is a mid-year event? And are you thinking more long, or do you feel like this is going to be more of one of those situations that is a softer, scenario in terms of recessions?
I'm looking at a lot as like the post-dot-com recession, right? That was one where it was a
Okay.
major impact for markets and a smaller impact for the economy. But obviously, it's going to depend on how policymakers handle that. One thing I think is that a lot of people, they fight the last war, right? So they look back, for example, at the 2008 recession, and now they start to fear that every recession is going to be like one of those. One big difference that I point out about this setup compared to that setup is that going into 2008, banks were the weakest they've ever been in terms of they had the smallest allocation they ever had as a percentage of their assets to risk-free assets like treasuries or bank reserves. And they had maximum exposure to loans, to riskier securities, and they had very loose lending standards, which means a pretty small rate of default could render them insolvent. Whereas now, because they're much more highly allocated to those safer assets, it takes a bigger problem to cause them to be outright insolvent. And so, although recessions will impact banks, basically, for example, you'll incur loan losses if you do have a recession. I don't think the problem is going to emanate from the banks, right? They're not the epicenter of the crisis in the way that they were in 2008, and instead, I think it kind of and that's how you get that explosive type of thing. When you have the banking system implode, that's more explosive. Whereas when you have it occur at the periphery, right? So first it's housing, right? Because the interest rates moved, housing activity slowed down. Also, auto loans have slowed down. The tech field, right? You have all these high valuation equities when cost of capital is free. Now that there is a cost of capital, those equity valuations have come down, which forces them to be more profitable, which slows their growth, which means you lay people off because some of that was just malinvestment. It was basically unrealistic expectations. So that gets slowed down. And of course, this keeps rippling through more and more and more sectors because of course those people that lost their tech jobs are going to now buy fewer other things. The people that are not building houses are going to buy fewer other things. And so this is like the type of recession I think emanates from the periphery and then moves in, rather than say the 2008 crisis that started from the center and then exploded outward from there.